When looking to buy a business, one of the key decisions you may find yourself faced with is whether to purchase the shares or the assets. So in this video, I will try and give the advantages and disadvantages of either a share sale or an asset sale so you can decide which is the best for you. When purchasing the assets of a business, you're purchasing both the tangible assets, which is often including the plant, equipment and stock of the business, and the intangible assets. Now those are being the goodwill, the intellectual property of the business. Now in this scenario, the vendor is usually a limited liability company. And often the asset purchases are structured for the best tax result, meaning the purchaser is designated as a going concern. The limited liability remains with the previous owner, but all assets are sold and the requirement is raised for that company to cease trading and close. When purchasing the shares of the selling company, the business remains trading and the buyer is purchasing the underlying control of that company. Now in this scenario, the vendor is actually the shareholders of the company, and generally speaking, you acquire ownership of all the selling company's assets and its liabilities by buying the shares in the company. Which is best? Well, the best option for you will invariably depend on your specific circumstances and, of course, those of the vendor company, the seller. However, as a general rule, I'll try and highlight some of the key advantages and disadvantages of an asset sale versus a share sale. Advantages of an asset sale. Flexibility. The purchaser can specify which of the assets they choose to purchase, and they can decide which, if any, of the liabilities they are prepared to take over. The risk is lower as the purchaser does not acquire any liabilities that it doesn't specifically agree to buy. Furthermore, the assets are generally acquired free of any encumbrance. In other words, they are freehold. Due diligence. The purchaser can tailor the scope and length of his due diligence investigation into the assets it intends to purchase. Therefore, that reduces both the time and the cost of doing a due diligence investigation. Valuation. Assets are often far simpler and easier and more cost-effective to value quickly and efficiently. Tax advantages. Depending on specifics, a purchaser may be able to reset the cost of the assets to market value at the time of purchase. A purchaser will need to talk to their accountant about how best to do this, but likewise any vendor tax losses can be used to eliminate their own depreciation recovered tax liability on the sale. So the disadvantages of an asset sale. The apportionment of sale price. The purchaser and the vendor can sometimes be at odds on how to apportion the purchase price between plant, equipment, land, buildings, stock, and goodwill. Now this can sometimes cause a conflict. A vendor's general preference will be to sell the assets for book value, while a purchaser will prefer a higher value to maximize their depreciation in later years. Cost of change of ownership. Depending on the number of assets going through the change of ownership process and reassigning key contracts of the business can sometimes be a costly and time-consuming process. No assignment or limited assignment contracts. Occasionally, key contracts may not be capable of assignment, and therefore that reduces the value of the business to the purchaser if they can't purchase those key contracts. GST. When the sale cannot be categorised as a going concern or does not involve an interest in land, GST could be payable in addition to the purchase price. Complexity. A high degree of settlement complexity is often involved when all the assets must be transferred and the change of ownership recorded with the various government regulatory departments. Now, in addition, appropriate measures to transfer employees or terminate employment agreements must also be put in place. Working capital. An asset sale starts with a clean balance sheet, therefore there's no working capital to support the initial trading stages of the business. Because of this, it's often necessary for the purchaser to put additional cash into the business as working capital. Now this will mean additional borrowing over and above the purchase price of the business. Advantages of a share sale. Apportionment. There is no apportionment of the sale price, as the sale of the shares are at a specific value and it's all that changes hands. The transaction is often more straightforward, simple and easier to do. Business continuity. All aspects of the business remain ongoing and the purchaser simply steps into the shoes of the seller. Now this will reduce the need for costly and time-consuming administrative changeover processes. No assignment contracts. Now, there are generally no problems against the assignment of any contracts since the contracting party remains the same. In other words, they're still the same company. However, it is sometimes important to consider the potential impact of any change of control provision in those contracts. GST. A share sale is treated as an exempt supply for the purposes of GST. Simplicity. Now, only the shares are being transferred, so the level of complexity is extremely low. Employment arrangements stay the same unless negotiated otherwise, as do supply agreements and trade agreements. Working capital. A share sale involves buying the full balance sheet, which will have ongoing working capital, including debtors, stock and creditors. So no additional cash is generally required by the purchaser. The majority of share sales are completed on a debt-free, cash-free basis. Disadvantages of a share sale. Well, the most obvious one is a complete package. The purchaser requires ownership of all the company's assets and liabilities, and they are unable to pick and choose which assets or which liabilities they would like to take over. Higher risk. All liabilities are assumed, and sometimes they can be unforeseen liabilities. For example, an historic tax liability, an outstanding employment dispute, or perhaps an outstanding warranty claim. Due diligence. Because of the level of risk involved, a more comprehensive due diligence investigation is usually required into all aspects of the business. Now, often this investigation will occur considerable time and costs to complete. Valuation. Determining the value of shares can sometimes be difficult, specifically when the company is not a listed entity and there is no history of share trade data pricing to fall back on. Tax. The vendor company may forfeit imputation credits if a 66% of shareholder continuity is not maintained. It may also forfeit the ability to carry forward tax losses if there's a 49% shareholder continuity isn't maintained. So you need to be a little bit careful about the tax implications of that sale. Banking and credit history. Now this is often easier to maintain under a share purchase, although it can be both an advantage or a disadvantage depending on that banking history. So it is fair to say that 95% of the sales that I broker are asset sales, and I would generally only recommend a share sale where there is a very strong commercial reason to do so. Now, the primary reason to recommend a share sale would be if the business had a significant proportion of contractual revenue, and assigning those contracts to a new owner could become a high commercial risk. Common examples of that might be a leasing company who has many leasing agreements with a number of clients in the company name, or a company that is running a large number of licenses for production of the products that they sell. It is important you get the right advice, especially when it comes to business structure, tax and financial matters. I strongly suggest you talk to accounting and legal professionals to help you make the right decision for you. Well, if you want to know more about business sales, have a look at these videos. I'll see you over there. Hit that subscribe button. Until next time, thanks for watching. See you then.